Okay, let's get right into this. It is Tuesday, January 20th, 2026. And if you are checking your portfolio today, or maybe you just, glanced at a ticker, you might be feeling a significant amount of whiplash.
For sure.
We just came back from the MLK long weekend.
Yeah.
And usually, right, you expect a slow start.
A little post-holiday drift?
Exactly. Traders are shaking off the cobwebs, getting their coffee, easing back in. But instead, we walked straight into a buzzsaw.
It certainly was not the gentle start to the week anyone had planned. The markets came back from that quiet holiday straight into what the report we're breaking down today calls a Scenario B flush.
A flush.
And honestly, flush might be putting it politely.
That sounds ominous. And wet, like something you don't want to be downstream of.
It's exactly as violent as it sounds. We're looking at SP500 futures, the ES down roughly 1.6%, right around 6,875. The mood just shifted instantly.
Like a what?
We went from, let's see what happens, sort of cautiously optimistic, to a hard, immediate risk-off.
And that is exactly why we're doing this deep dive.
Yeah.
We've got the January 2026 ES market breakdown report right here. Our mission today is to figure out, why the floor just fell out. What is the so-called smart money doing while everyone else is panicking? And the big one, is this a buying opportunity or is this a falling knife?
That is the question of the day. And for you listening, whether you're actively trading this tick by tick or just, watching the headlines with one eye closed, we need to connect the geopolitical dots to the hard financial data.
Because it's not random.
No, looking at this report, this move feels chaotic, but there is a specific mechanism at work here.
Okay, so let's start with the catalyst, the spark. We went away for the weekend, everything was fine, looking at highs, and we came back to just red screens. The report calls it the tariff tantrum.
It was a headline bomb, effectively. The news broke about renewed tariff threats, specifically targeting European allies.
Sure.
But the curveball, the thing that really seemed to spook the algorithms, was the tension involving Greenland, per the new administration's rhetoric.
Greenland. I feel like that wasn't on anyone's bingo card for January 2026.
Yeah.
That seems fringe.
It's rarely on the bingo card. But you have to understand, markets hate uncertainty way more than they hate bad news. Bad news, they can price that in. They can do the math.
Right.
But political rhetoric involving territories, that is unquantifiable. And these headlines just shattered the quiet weekend. You have to remember, coming into Friday, there was this confident buy the dip crowd positioned above 6,950.
Right. They went home for the long weekend feeling pretty good about themselves.
Exactly. Thinking, I'm positioned perfectly for Tuesday. And now those people are trapped.
How so?
The market gapped down. That created a massive supply of what traders call bag holders. These are people holding positions at a loss, desperate to just get out at break even.
So every little rally is met with selling.
Just people trying to stop the pain. It compounds the pressure.
Yeah, I want to be really clear here, because politics can get heated, and we are not a political show.
Not at all.
We're not here to debate tariffs or if Greenland is strategic real estate.
Nope. We're just looking at the plumbing. How does the market machine process that input? The news is just a data point. And the first thing that broke in that machine was the volatility gauge.
The VIX, the fear gauge.
Exactly. The VIX spiked from 1640 on Friday to 19.85 today. That is a massive move.
So I think most people know VIX up, stocks down. But why does a specific number, like going from 16 to almost 20, actually matter to the mechanics? Why isn't it just a scoreboard?
This is where we get into the real insight. It matters because of what are called vol control funds. These are massive institutional funds, we're talking billions, whose entire strategy is based on math.
So it's not a person making a gut call.
No, it's autopilot. When volatility is low, their models say, okay, it's safe to lever up, buy stocks. But when volatility expands this fast, their models just scream, risk is too high, and force them to sell. It's not a human decision. It's an algorithm executing a mandatory liquidation.
So it's a feedback loop. Headlines cause panic, VIX goes up, robots are forced to sell, price goes down, VIX goes up more.
You've got it. It turns a stumble into a shove. And that brings us to the physics of the market itself. The report uses some vivid language here. Invisible walls and negative gamma.
This is the part that stood out to me. Negative gamma sounds like something that gives you superpowers. But here it sounds like a very dangerous place for your money.
It is. I'll do my best to break it down. Think of gamma as the stability of the market floor. When we're in positive gamma, market makers, the dealers on the other side of your trade, they act like shock absorbers.
Okay, they dampen the volatility.
Correct. If you sell, they buy. They stabilize things. But the report says we've crossed below the zero gamma level, which is right around 6,950. We are now in negative gamma.
And the shock absorbers break.
They vanish. Worse, they reverse. In negative gamma, to hedge their books, market makers are forced to trade with the trend. As price drops, they have to sell futures. As price rises, they have to buy.
So they become an accelerant.
It's like throwing gas on a fire. The market becomes slippery, price moves get exaggerated and fast.
Which explains this morning, it wasn't just finding a new price, it was sliding on ice. And the report mentioned specific levels. 6,950.
That's the concrete ceiling. Last week, it was support. Now that we've broken through, it's heavy resistance. All those trapped buyers we mentioned, they're waiting to sell there. And because of the negative gamma, the dealers will be selling there too.
Okay, so concrete ceiling above us. Is there a floor below us, or are we in free fall?
There is a floor, but it's a different kind of structure. The report identifies a put wall at 6,850.
A put wall. That implies options.
It does. It's a price level with a massive amount of open interest and put options. Essentially, a lot of bets or hedges at that specific number. Dealers are typically short those puts.
So what does that mean for the price? How does that act as a floor?
Well, if the price slams to 6,850, dealers might be forced to buy futures to hedge those puts. It can create a mechanical bounce, a kind of stickiness.
So 6,950 is a ceiling they sell into, and 6,850 is a trampoline they might have to buy on.
That's a great way to think about it. But we can't just look at the S&P. We have to talk about the other elephant in the room. The bond market.
The yield ceiling.
This is arguably just as important. The 10-year Treasury yield is sitting at 4.23%.
And is 4.23 really that big of a deal? I mean, historically, it's not crazy high.
Context is everything. In the context of S&P valuations, it is critical. The report calls 4.20 the danger zone. We've broken that. But what's really scary is the correlation. Usually when stocks crash, where does money go?
To safety. Bonds. You sell stocks, you buy bonds.
Right. So stocks down usually means yields down, a seesaw. But today, stocks are down and bonds are selling off too. Yields are rising.
They're moving together. The correlation flip.
It means a true liquidity drain. Money is leaving the building entirely. And from a valuation standpoint, if I can get a risk-free 4.23% from the government, why am I paying a premium for stocks at 6,900? The math gets tough.
It's a reality check. And this check isn't hitting everyone equally, right? We're seeing a split in the sectors.
We are. It gives us clues about the market's internal health. It's a classic safety trade. Utilities, consumer staples, think electricity and toothpaste, they're outperforming.
And outperforming just means down less, I assume.
Precisely. They're losing less money. Meanwhile, the victims are exactly who you'd expect. Tech and industrials. They have the most exposure to a trade war.
The report specifically flags two names to watch. The canaries in the coal mine, NVIDIA and Apple. Why them?
It's all about weight and sentiment. They're the heavyweights. They carry the index. If NVDA and AAPL fail to hold their intraday lows, the report warns that the ES will likely test that 6,850 floor.
If the generals fall, the army retreats.
You can't have a market rally if NVIDIA is puking.
So, macro picture, tariffs, yields up, tech down. But what is the smart money doing? The report references the commitment of traders, or COT report.
Right. The COT report tells us what the commercials the big institutions were doing before this happened. And interestingly, they were net short through the long weekend.
So they were positioned for a drop.
They were. They didn't buy the hype last week. Now, as the market drops, they're covering some of those shorts, but, and this is crucial, the report says they are not aggressively buying yet.
Just closing out profitable bets.
Exactly. And there's another metric, open interest, or OI. The report says it's spiking as prices fall.
What does that tell us?
This is a huge signal. If prices were falling and OI was dropping, it would just mean people are closing out bad bets and going home. Weak selling.
But that's not what we're seeing.
No, OI is rising while prices fall. That means aggressive new short positions are being open. The bears aren't just watching, they are stepping on the gas.
They smell blood.
Yeah.
And the chart damage confirms it. We lost the 20-day moving average.
Around 6,940. That was the short-term trend. It's gone. The next major support isn't until the 50-day, which is all the way down at 6,780.
That's a long way down. And the report mentioned a gap-and-go pattern.
That's what we saw this morning. The market closed Friday up here and opened Tuesday way down here. That empty space is the gap. Today, it gapped down and just kept going, a sign of extreme weakness.
Okay, so the picture is grim. Slippery, robots are selling, smart money is shorting. But this is the deep dive. The report outlines two specific strategies. Let's look at strategy one, the tariff fade.
This one's rated 4 out of 5 stars. High confidence. It capitalizes on this sell rallies regime we're in. The logic is that algorithmic bots will sell every single uptick.
So how do you play it?
The discipline here is waiting. You don't short in the hole, you wait for a little relief rally. The report targets the intraday VWAP, which is between 6,900 and 6,910.
Okay, we bounced to 6,910. Then what?
You watch for a rejection candle, a shooting star, something that shows buyers tried and failed. Then you short it. Target a retest of the lows at 6,870.
And the stop loss?
Tight, 6,925. If BIC breaks above that, the thesis is wrong, you get out.
I like that. Now, strategy two is spicier. The 600-850 floor. Only 3 stars. High risk. Why?
Because you're trying to catch a falling knife. This is the contrarian scalp. It's a bet on those put wall mechanics we talked about.
You're stepping in front of the train hoping its automatic brakes kick in.
That's a good way to put it. The setup is a limit buy at 6,852. Target a quick scalp back up to 6,875. You're in and out.
And the warning is in bold print.
Yes. Hard stop at 6,840. Non-negotiable. If that wall breaks, a liquidation to 6,800 could happen immediately. You take your small loss and you run.
So that leads us to the verdict. The report says we're in price discovery to the downside. The trend is bearish. It lays out 3 scenarios.
Right. Scenario A. The most likely, at 55% probability, the bear flag and drop.
And this assumes yields stay high.
Correct. Above 4.22%. The market chops around between 6,807 and 6,895, bores everyone to death, and then into the close, the selling resumes and breaks the lows.
So the action there is stay short or flat.
Do not buy. The chop is a trap.
Then there's scenario B, turnaround Tuesday stabilization, 35% chance.
This is the optimistic view. Tech finds a bid, VIX retreats below 18, we reclaim 6,900. In that case, you take profits on shorts. But, and this is key, the report says do not go long yet.
Just take the money and sit on your hands.
Let the market prove it can heal.
And finally, the nightmare. Scenario C, total washout, 10% chance.
This is if we get new headlines, or the 10-year yield hits 4.25%. If that happens, we slice through 6,850 and target 6,800. This is the look out below moment.
So putting it all together, the long weekend protected traders, but Tuesday forced everyone to face the music. The trend has flipped from neutral to bearish.
That's the synthesis. The core message is sell rips, do not buy dips. You have to respect the momentum. When the gamma is negative and the vol control funds are selling, the path of least resistance is down.
Swimming upstream is how you blow up an account.
You have to flow with the river even if it's going over a waterfall.
It's a sobering reminder of how fast things can turn.
It is, and it raises an important question for you listening, whether you trade or just own index funds. If a single weekend of headlines can shatter the floor so violently, how stable was that rally to 6,900 in the first place?
And that is the provocative thought I want to leave everyone with. Was the market reacting to the tariffs, or was it just looking for an excuse to correct?
Because if the structure was that fragile, maybe the tariffs were just the pin that popped the balloon. It suggests the valuations were maybe more precarious than people wanted to admit.
Exactly. When the market is looking for a reason to sell, it will always find one. And that is where we leave it for today. Watch those levels. 6,950 is your ceiling. 6,850 is your floor. Stay safe out there.
Thanks for listening to The Deep Dive.
Trade safe.